Hey everyone, welcome back to Corporate Decoder. Today we're diving into Corebridge Financial's latest quarterly filing. It's like reading tea leaves, except instead of tea, it's mountains of financial jargon. We'll decode the story hidden inside, so buckle up. I see a company trying really hard to impress, but let's see if the numbers back up the hype. We are going to try to simplify Corebridge Financial Inc. Form 10Q, a quarterly report that gives us a snapshot of the company's performance and financial standing as of March 31, 2025. First, let's check the big picture. Total assets are up a bit from about $389. Total shareholders' equity, the value belonging to the company's owners, also increased slightly to $12 billion. This hints at stability, but it is not explosive growth. Now the real meat, the income statement, revenue, the lifeblood of any company, has fallen drastically from $528 billion to $325 billion, a bit deeper. Net income, the profit that remains, the company is reporting a loss of $657 million, which is not great when you compare it with $827 million of profit from last year. That translates to a loss of $1.19 per share, a stark contrast to the $121.41 earnings per share last year. Clearly, something happened there. So what went wrong? Policyholder benefits seem to be a main culprit, with a decrease by about $1.4 billion this year and about $1.4 billion of drop in premiums. Now, the cash flow statement shows that the company's cash decreased about $400 million. This can be a concerning trend, which means they had to sell a lot of assets in cash. Let's try to focus in on Corebridge's different activities. Okay, so it seems like in the most recent quarter, compared with the previous year, they are earning less from what they are doing, $4.7 billion to $5.8 billion. It's never good to see the revenue drop. A huge part of what Corebridge and similar companies do is assess risk. So let's see how good they are with managing their own investments and at measuring fair value. The vast majority of the balance is categorized as level 2 assets. These assets are based on inputs other than market value, so it tells us that the fair value measurement has some human judgment involved and is not totally liquid. Now let's talk a little bit about Corebridge as a company. Let's check the equity section. There's been a buyback of company stock, meaning Corebridge believes in itself and is investing into their own market value, which is always a good sign. Digging a little deeper, the report mentions a revolving credit agreement, basically a corporate credit card, with a sizable $3 billion commitment. The report also mentioned interest payments in cash. Let's check that. Interesting to see interest payment is almost double what it was last year, $111 million versus $61 million. That means that debt servicing and rates have probably increased a lot for the company. So what could throw Corebridge off course? Risk factors is usually the name of the game. Well, first and most obvious is ongoing litigation. They are fighting on several fronts, and the outcome, as the report says, is difficult to predict. Let's talk taxes. It seems as though certain tax laws may significantly impact the sales of their products. Also to note here is that there is a limitation to the amount that can be used from net operating loss carry forwards from previous events, and tax credits to offset tax liabilities. This could definitely impact the tax liabilities in the future, and it's worth keeping an eye on. There are also risks related to AIG, Nippon, and Blackstone. I don't see any specific details here that jump out, but it is important that these partnerships remain stable. We also see that Nippon owns approximately 22% of the shares. The tax matters agreement is also important to note. Corebridge can be held liable for previous AIG tax liabilities for taxable years or portions thereof, so if that liability comes, they will be in trouble. Other modern risks are present, technological changes such as AI and cybersecurity. They also mention difficulties complying with public company obligations. Corebridge also struggles to retain key people. I wonder what the office culture is like. Finally, this is the most common one, but the models may not actually reflect reality. The report states it is to allowing for a deeper understanding of the profitability drivers of our business, results of operations, financial condition, and liquidity. The use of these metrics is always an art since it lets the company paint a picture, so we need to be wary. Realized gains and losses seem like they are conveniently ignored. This can paint a really bad picture, as these mark-to-market gains and losses can be huge, such as the loss mentioned previously. Amortization of deferred policy acquisition costs, or DAC, is grouped and amortized on a constant level basis, i.e. approximating straight-line amortization with adjustments for expected terminations over the expected term of the related contracts. Straight-line amortization is easier to understand because it is a constant and fixed cost that can be expected in the future. This is good to know. Finally, let's look at something that can really cloud up results: minority interests. For this section, from what I can gather, the key point to note is that a portion of the company's profits belongs to other people. And it is also required by other to hold restricted cash. There isn't anything strange here. We have the standard related party boilerplate text. Nothing here jumps out in particular, except these should be closely followed. Finally, as a warning, don't take any of this document or anything in this video as financial advice. I'm some person in the internet, not a financial advisor, so do your own research and consult with a professional. So what's the overall story? Corebridge is going through a rough patch with profits plunging. They're trying to blame market conditions, but are they adapting fast enough? It feels like Corebridge is still very dependent on legacy structures from AIG, but they're also making efforts to be independent, especially in things like the IT and the Blackstone deal. I wonder how they're going to manage through the transition while keeping shareholders happy. The decrease in revenue and the increase in interest payment will be an important thing to look out for in the future. Drop your for the company's future. Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. You can find more analyses and discussion in our Discord linked in the description. Thanks for watching. See you next time.